Hello and welcome to the program. My name is Margaret Lomas and you're tuned into Your Money, Your Call. Thanks for joining me again this week as we take a fresh look at property all around the country. Before we get to your calls, let's take a look at what's making news this week. And according to a recent study by financier Bankwest, Australia's love of medium-density housing is running hot. Demand for units, townhouses and semi-detached homes across Australia continued to rise over the past 12 months, reaching the highest level on record. The Bankwest Housing Density Report revealed 43.4% of total new home approvals were for medium-density dwellings, an increase of 22.9% on the previous year, which is considerably higher than the 6.5% increase in standalone home approvals. While data shows approvals for medium-density housing growing by a healthy 45.9% over 5 years, approvals for standalone homes fell by 8.5% over the same period. And property spruikers would have been warned that they must be licensed to offer financial advice if they're targeting people with self-managed super funds, or suggesting that people should establish their own fund to buy real estate. People who advise on direct property do not need to have an Australian Financial Services licence, but people who make recommendations that involve SMSFs do need a licence, as superannuation funds are considered financial products. ASIC warned investors to be wary of property spruikers and ensure that any advice they took was right for their circumstances. The Australian Tax Office, which regulates SMSFs, was also monitoring property transactions through the funds. Acting Second Commissioner Alison Lender said the ATO was checking that the investment decisions self-managed super fund trustees were making were aligned with their funds' trust deeds and investment strategies. With me tonight to discuss these stories and answer your questions is Ben Kingsley from Empower Wealth. And that's not Ben, that's Brad Matthews from Rescom. And Ben's there somewhere, just sitting off to the side. You'll see him in a minute. And if you have a question for anyone on the panel tonight, you can call us right now on 1330 3435, or you can email it to property@skynews.com.au. Welcome to the program. And welcome to you both.
Thank you.
I'm going to be getting you confused now. Brad, I'll be calling you Ben. We should just call you B1 and B2. That might be a little bit easier for
Works
me.
for me.
So, look, we're all on the board of the Property Investment Professionals of Australia, and we've been lobbying hard for a long time now for ASIC to take some kind of role in regulating the property investment industry, which they steadfastly refuse to do for many, many reasons, and the government won't help. But it looks like now they're finally seeing that self-managed superannuation funds are a problem. Brad, it's good news?
Oh, absolutely good news. It's just astounding. It doesn't matter which government it is, whether it's left-wing, right-wing, Liberal, Labor, all of them have just sat on their hands for years and done nothing.
Absolutely. Look, I guess the biggest problem for us is that we've been lobbying the government at the PIPA level for almost 8 years now, and they make a couple of promises and then they break them, and it's just not important to them in terms of votes.
Yeah, and I don't know what the hard part is.
Okay, all right. Now, you know, I think I'd like to ask you some questions, Ben, but I believe we're having some trouble with the camera. So, okay, well, let's go for that. We'll go for a wide shot so I can talk to you too,
Sure.
Ben, if that's okay. And all you need to do, I guess, is, yeah, look at the people out there and say hi to them and talk to me. Ben, what are the main issues that we're facing in terms of the government? Why do they refuse to regulate, do you think?
Look, it's a challenging space because what we've got is owner-occupiers playing in the space as well as investors. Now, we don't think it's challenging, but from a regulation point of view, the government's sort of saying, how do we find a way of getting that balance right? We think it's relatively easy. So in the sense that if, you know, the consumer declares that their interest in buying this property is for investment purposes, then we think that regulation would need to be placed in that particular marketplace. So that's what we're looking for. We're looking for the government to take action in this space and really leading by example in that particular area.
Yeah, look, I think the biggest problem is that ASIC, I can kind of understand that ASIC doesn't want to take a supervisory role because from ASIC's perspective, that becomes too hard for them. It means a whole new level of governance. But by the same token, ASIC refuses to recognise property investment as a financial instrument, yet it's become so, hasn't it, Brad? It really has become so.
It's going to take a whole lot of people to lose a whole lot of money before anybody's going to say, oh, we should have done something about that.
Yeah.
And
It's happening, though, already. A whole lot of people are losing a whole lot of money, and that's the whole problem.
Yeah.
Ben, one of the things that I have an issue with, and a couple of years ago I was engaging with Bill Shorten when he was in his role as Minister for Finance, and he was giving me the brush off left, right and centre. I think he got tired of the fact that I kept on handing his email address out to all and sundry and asking them to write to him. And his point was, well, you know, we've already got reform in the form of the Credit Act. But that doesn't do anything, does it?
It's such a high value transaction. We're talking about people's livelihoods and households' livelihoods. It's crazy to think that I can do $2,000 worth of investments in BHP and I've got to get a statement of advice, or I've got to go through risk profiling as someone who's licensed and qualified to do so. Yet I'm about to spend $500,000 on an investment product like a property, and there's no regulation around it. So what we see is real estate agents, marketeers, mortgage brokers, accountants, all with views around what makes a good quality property investment and what is investment grade from a property point of view.
And failing to disclose the commissions they're receiving.
Correct. And when we all know that not every property, if anything, maybe 10%, or some would even say 5%, making investment grade. So we've got this situation where people are losing money, or the opportunity cost of being in a bad investment for 10 years. They're paying interest on that property, and they sell that property in 10 years from now, and they've lost money once they work out everything that's been involved in it. It's just a disaster.
I took an email myself today from a buyer who bought one such property in Moranbah, paid some $700,000 for it. It's been vacant for quite a long time now, and they will struggle to sell that for $300,000 in the present market. Very good sell job done on them by a fairly well-known property investment advisor, and it's tragic to see these people who just about to have their first child and really struggling. So
it's horrible, isn't it?
Yeah, it's awful. Well, look, let's go to the emails. And Leo wrote to me through the week because he's been holidaying up on the Gold Coast for a while, and now he's thinking about buying there. Leo says, I'm thinking of investing in a holiday apartment in Broadbeach on the Gold Coast because my family and I enjoy holidaying there. Is it a good area to invest in? That's from Leo. Brad, I don't know about using your enjoyment of a holiday as good, strong investing criteria.
Not at all. Leo, I would look at it this way. Holiday wherever you want to, but that doesn't necessarily mean you invest where you holiday. There are key drivers to look at when you're looking at an investment, and because you have a good holiday there doesn't mean that's where you would invest.
Absolutely. And often people, Ben, want to buy where they holiday to for that excuse of being able to inspect it or use the apartment, particularly if this is a holiday apartment. You can guarantee that the spruik who's selling it's thrown in a free holiday as well.
Every year, Margaret, every year you get to spend 4 weeks free in your own apartment. And they'll have, the property managers coming in, and they'll bring someone like an Accor in or a major, hotelier to manage the property. Now, if they don't get the results and performance that they're looking for, they'll bring the next hotelier group in, and then all of a sudden they'll be asking for $20,000 to refresh the apartment so they can get the occupancy rates up. So, let's separate investments from leisure activities.
Yes. We need to be very careful, Leo, because very often when we go on holidays we feel great. There's often a holiday apartment for sale in that area, and we get sucked into buying that without looking at the growth drivers. Where the Gold Coast is concerned, some say that it's at the bottom of the market, and even if that were true, there is still a fair oversupply of properties to work their way out of that market, and I think you're looking at years upon years upon years before we start to see a decent growth returning back to the Gold Coast. So the fundamental growth drivers really aren't there to make it a good investment. Just because you enjoy it as a holiday place, that doesn't make it a great place to invest. Be very careful about holiday apartments. Very often costs blow out and you end up with a good gross return and a terrible net return after all of those expenses are taken into account. And on top of that, if there's a rental guarantee, well, that just seems to sweeten the deal, and in fact it can be just covering over the top of what could be a poison deal after all. So be very careful, Leo. It's great to have you here this week, and of course if you call or email email and ask a question, you could get a copy of my latest book. It's called How to Achieve Property Success, and it's the combination of my first 3 books. It's the complete guide to buying property and covers everything that you need to know, from tax and gearing through to finance and conveyancing. All you have to do is call us now on 1300 30 34 35 or email property@skynews.com.au with a question. Make sure you watch at the end of the show to see if you're the lucky person. We're off for a break. Don't go away. When we come back, we'll take some calls and also answer some more email. Welcome back to Your Money, Your Call. Joining me tonight is Ben Kingsley from Empower Wealth and Brad Matthews from Rescom, and we're standing by to take your questions. Now, if you have one, grab the phone and call us on 1300 30 34 35, or of course you can email us on property@skynews.com.au. And we do have some callers on the line. First of all, Cass, you're from Point Cook. Welcome to the program, Cass.
Thank you very much for that.
How are you going?
Now, basically, my question is around some figures I had a look at recently. Looking at figures from RP data that came out recently and taking population growth into account, it appears that the Melbourne market is undersupplied. Now, are areas within the 7 to 14 kilometre radius of the CBD the best for building units and semi-detached unit properties in order to get a capital gain and a good rental yield?
Okay. Well, you happen to have called on exactly the right night tonight, Cass, because my 2 guests are both from Melbourne, and we would hope that would mean they're quite familiar with it. He does talk, however, about units, and he's talking about an undersupply, and he's talking about units, and I'm just not sure that that's entirely true. I think the undersupply, Brad, is, you know, I think there's an oversupply still, certainly in that inner ring, in apartments in Melbourne.
Yeah, it depends on whether you're looking at apartments, Cass, or whether you're looking for units or anything like that. If you get close into the CBD, there is mammoth amounts of residential apartment buildings, high density, that are going up. But then, of course, once you start going out to 7 to 14 kilometres, and then you have to look as whether it's north or whether it's west or east or south and things like that. So I prefer to actually narrow down on an area rather than give a generic, there's an oversupply or undersupply in Melbourne per se. Yeah?
Absolutely. What do you think about Cass's question, Ben? He's looking for the places that he should be building at the moment, but...
Look, Margaret, the research is clear that the government wants to see the arterial corridors coming into the CBD as being medium density. So we're seeing situations like Sydney Road and High Street into the northern corridor, Mount Alexander Road into the northwestern corridor, where they're putting medium density accommodation through there. So in terms of the question or the answer for Cass is, I wouldn't necessarily be looking at those particular projects because of the supply conversation and, you know, the values and the underlying values in those particular areas. But what I would be looking at, I don't mind that 7 to 14 bracket in terms of, and just looking at cherry picking some of the older stock in the smaller buildings where you've got proven resale value and you absolutely know that basically there's a demand for that type of accommodation. So, you know, the bigger story he also mentioned about population growth, generally bringing a population to an area doesn't ensure guaranteed capital growth. You know, they need to have the incomes to drive that value higher. So there's still more research to be done just than the population and just looking at an area saying it's undersupplied or oversupplied.
And I think that's exactly right, and certainly there are many areas in Melbourne, particularly in the inner ring, which are very oversupplied. That middle ring at the moment seems to be the place that may be about to grow next, though. We did see a lot of growth in the outer ring a couple of years ago. A lot of people made some good money from investing in that outer ring in response to the Melbourne 2030 plan that identified those transport hubs around the outside of Melbourne. Now that plan has started to move a little bit further in, and it's identifying that inner ring, as Ben has pointed out, for that medium density growth. So I think that that's probably a good area for you to be exploring, but be very careful because there are still parts of that that are now starting to get into oversupply. Where the developers are probably where you shouldn't be, and I'd be looking at areas outside of where you see the developers moving at the moment if you're looking to build maybe a smaller development yourself of 3 or 4 apartments, which I gather is what you're trying to do. Carol from Port Hedland, welcome to the program, Carol.
Thank you very much, Margaret and panel. I hope you're all well tonight.
We certainly are. What can we do for you?
My husband and I have got a few investment properties, but we can see in the future that we'd probably want to put our toe in the water with commercial property. And so I'm wondering whether there's any good literature that you can suggest or recommend that can get us educated before we get there.
Absolutely. Well, let's go to the panel. And Ben, do you know of any? I know there's a couple of books out on commercial real estate. I can't recall their names off the top of my head, but maybe you'd like to talk to this one.
Yeah, Carol, thanks very much for the call. The first question I have, and it's the same question I have when I'm advising my clients, is around why do you think there's a need to go towards commercial? The argument from some very, very smart people who have been in the valuation game, in the property game for many years, someone like a Scott Keck from Charter Keck Kramer, he's a big advocate to say that, you know, you need around $5 million worth of residential property before you start taking the footstep into commercial property. You've got to understand with commercial property, you've got a lot more volatility. There might be some attractions around the tenant paying for most things and the yields looking higher, but you still got to understand the fundamentals, and that is that you're in a volatile market. If your wealth base can accommodate that, then you can certainly start looking for that type of information. The big companies like the Colliers and those sort of Frank Knights, they have a lot of research pieces that you can Google and find and learn more about the sort of larger commercial properties and those types of things. So that's the literature that I'd be going to, because it's fairly up to date and modern. But really, I'd be asking you how many is enough in terms of your residential wealth base before I'd be moving towards commercial.
I agree with Ben and Brad. Certainly you've done a bit of commercial investing yourself, and it is a different ball game, isn't it, than investing residentially, and the risk is much greater.
Yeah. Carol, just to add on to what Ben has said, and also Margaret adding in, if you have a very good substantial residential portfolio, because that is your fallback position, then you can look at commercial. Residential is fantastic because everybody needs a residential property, but unfortunately with a commercial property, you're actually buying or paying for the tenant. Okay, that's the main thing. So you may have a good commercial property, but when the economy slows down and things go bad, it's actually the tenant who's paying your interest bill. And if their business, for whatever reason, has any form of adversity or anything like that, they can shut the business down, and of course it's in adverse times if they shut the business down that you have to then get another tenant. So the only reason that you would look in commercial property is if you have an excellent residential property first. That's what I would look at.
And look, Carol, I'm gathering that you're seeing commercial as an opportunity to diversify, but I don't see it as such. I think if you're going to diversify away from residential property, it needs to be into some other asset class altogether. I think all commercial property does to you is add a level of risk, and absolutely, if you can afford to take that risk, do so. But I've seen many commercial properties that remain vacant for years on end, really sending that person who owns it into severe financial distress. So I think you need to be very careful, maybe diversify geographically with your residential property first, get a lot of that under your belt first, then think about either going to a different asset class altogether, or if you really must do commercial, just make sure that it's safe to do so. It's time to take another break, but if you do have a question for us, call and you might get a copy of my brand new book, How to Achieve Property Success, if we read out your question and select you. All you have to do is call us now on 1300 30 3435 or email property@skynews.com.au and make sure that you watch at the end of the show to see if you're the lucky person. We'll be right back. Thanks for staying with us. This evening I have Ben Kingsley from Empower Wealth and Brad Matthews from Rescom in the studio and doing a great job answering your questions. So call us now on 1300 30 34 35 to join the queue, or email us on property@skynews.com.au. Now, Lara has sent in this question to me this week, and she said, "Hi, Margaret and co. I'd like to buy my first investment property. My accountant has suggested that I purchase a new build so to benefit from the tax benefits due to depreciation. However, I'm concerned that a new build might restrict my choices of location. I'm considering near Brisbane, but have seen some attractive offers to purchase new apartments in Canberra, where they offer to pay your stamp stamp duty. What do you think? Okay, just quickly on this one, Ben, the accountants always say you need to invest so that you get this depreciation and all these tax benefits, but there's a lot more to it than that.
Absolutely. I mean, the accountants know what the accountants know, and this is coming back to that advice piece. You know, they're giving advice based on tax, and obviously that's something that we normally do. So golden rules of thumb, any incentives, any inducements, then usually an investment's got to stack up on its own merits. If you've got these discounts or these inducements or these incentives, run.
Excellent. And what about Canberra? I don't know.
Well, the thing that I would look at, any time you're getting something given away, it's usually included in the cost. No vendor, especially if it's a developer, is savvy enough to say that they're going to give you something for free. It costs. It's as simple as that.
Absolutely. It's built into the price. Lara, just a couple of very quick things for you. First of all, Canberra is one of those markets where there's plenty sold and plenty bought, but it's all in balance, so there's no real pressure anywhere, and I think that will last for a fair while. And in the cities, there are plenty of apartments, so they're headed for massive oversupply on inner city apartments. I think that's a bad idea. With regard to depreciation, you can get depreciation on most properties, and even the really old ones, usually they can squeeze something out of it. I always believe that buying near new is better than buying new. Something 2 or 3 years old that someone else has bought still has almost the same amount of depreciation and usually is much cheaper on the buying price because all of that developer profit or the spruiker's commission is gone, paid by the person before you. I think there's plenty of places you can buy, but Brisbane is definitely one that interests me this year, and I think we're going to see some great gains up there in Brisbane, so it's not a bad one for you to be thinking about. Siva from Sydney, you're looking at Woodridge or Woodbridge?
Yeah, thanks, Margaret. I love your show. I have a question for the panel. Actually, 2 questions. The first question is I'm looking to buy a 5-bedroom house in Logan area, in Woodridge area.
Yes.
And it will give about 8.5% yield because the house is actually split into 2, a 3-bedroom at the front and a 2-bedroom unit at the back. Even though it's the same house, it's actually dual living.
Okay.
But they put in a wall to separate the 3-bedroom and the 2-bedroom.
Okay.
But it's not council approved, so I'm concerned, if I buy this,
yes.
It may not be council approved. And then the second question is, if I can't buy it there, I'm looking at a property in Wayland, in Western Sydney, which has a granny flat in there, and again, that might give me 7.5% yield with a house and a granny flat, a 1-bedroom granny flat.
Okay, a couple of things that are concerning me here. First of all, talking about yield over anything else, but there's nothing wrong with Woodridge. Just quickly, Ben, there is something wrong with buying a property without council approval.
There's something very wrong with buying that. Basically, you're giving the council the ability to come and say, tear that bit down, or so you just simply don't want to go into an investment that doesn't have all of the check boxes ticked from a legal point of view, Margaret.
And look, I think we might discuss this further after the break, but for now we're off for a break, and when we return you'll have another chance to get hold of a copy of my brand new book, How to Achieve Property Success, but you must ask a question and then have it selected. Call us right now on 1300 30 34 35, or you can also email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas. With me on the panel tonight is Ben Kingsley from Empower Wealth and Brad Matthews from Rescom. Now, if you have a question that you think we can answer, and I'm sure we can answer most of them, call us now on 1300 30 34 35 or email us on property@skynews.com.au. Now, before we go to the next caller, look, I'd like to just talk a little bit further about that one for Siva. He was talking about Wayland and Woodridge. Woodridge is really quite close to transport and also in that Logan Shire, which is really going well at the moment. Wayland, I'm not so sure about, Ben.
Yeah, look, the infrastructure and the lifestyle test to me, I don't think it has a good walk score and conveniences, so everything's drive. So I think from my point of view, you're going to attract that lower socio-demographic into that area, and that's a concern for me. I like my tenants to be more stable and certainly more reliable from a paying point of view. So it might look good on paper, but I think the proof's going to be in the pudding in terms of how long and how stable the tenants are.
And certainly, Siva, there is nothing wrong with investing in an area with a lower socio-economic socioeconomic group in there. In fact, Woodridge has been such an area. There's been a lot happening in that area, though. We're seeing a slow demographic change, lots of transport infrastructure, and it's really getting carried along by all of the growth that's happening in that area. So that would be my preference, but I think you need to stay away from that uncouncil approved property. That's going to cause you grief for a long time, and I think you can probably do a lot better than that. Danny, you're from Cherrybrook. How can we help you?
Thanks for taking my call, Margaret. Really appreciate your expertise and that of the panel you put together today. I am thinking of investing between $500,000 and about $800,000 in property as an investment so that I could probably give it to my kids in time to come. Now, if I was doing that, would it where in New South Wales or around Sydney that I could make that investment, or should I invest it somewhere else?
Okay, this is almost a how long is a piece of string question, because there's certainly plenty of areas, and I guess at the top of the show we already talked about the fact that when you buy property as an investment, you've got to do a whole lot of things, including know more about your needs, how long to retirement, and all of those other things as well. Brad, 500 to 800,000, I guess anywhere is probably on his agenda, but he shouldn't invest just anywhere.
Yeah, no. The one thing I would do, Danny, is grab one of Margaret's books. And that may be one way that you can be certain you'll get the book tonight, possibly, because there are a whole lot of key drivers to look at when you're looking to invest. And I salute you as a parent looking after your children for the future, so you have to look at your time scale, and then you have a look at whether you're going to be giving the children these properties when you're deceased, unfortunately, or whether it's going to be some form of property that you're buying for them now for 5 years or 10 or 15 or 20 years, whether it is a pure investment, whether you're looking for a marital gift or whatever it may be, but then look at the drivers that go behind good investment properties.
Ben, 800,000, he probably, if he's got a couple of kids, can probably split that up and buy in a couple of different areas. You know, look, I love Sydney as a market, but I do think it's quite overheated. And I think if you're only thinking about buying there now, you might have left your run a little bit too late.
There's no doubt you haven't picked the bottom. And Danny, one of the things that's going to help you in the selection process is what type of returns are you looking for? So obviously we know in property investment we get the capital growth return and we also get the yield returns. The question for me is looking at how you're going to model those cash flows to see when does this property become cash flow neutral, when does it become cash flow positive, are you going to be able to retire the debt out in the time frame that you've got to do that. So one of the things I'd be saying to you is work out from your point of view, is this a capital growth play primarily, or are we looking at a bit more of a yield play? Because those two decisions will actually help me as an advisor to then sort of isolate the areas that I'd be putting you into or recommending to you.
And look, I agree with that. I think one of the most important things for all investors, however, is to understand that it doesn't really matter how long you have to invest. At the end of the day, you've got what you've got. It could be 5, 10 or 15 years. And your aim should be to get the best possible growth for the best possible yield in that period of time. You can find areas that are about to grow really well in value that also have growth drivers. That means that the yield will grow at the same time. In a normal market, it's either growing or its rent is going up. But in some markets, both of those are happening concurrently. And there are specific drivers that will tell you whether that's the case. And they include things like population growth, infrastructure planning, diversity of industry, and more importantly, big industry coming into town and relocating things like their call centres and their warehousing and their logistics centres. If they're doing that, then it's because they believe there's going to be a long-term market for them, a long-term supply of employment, and they also really impact back on employment too. Now, it isn't just one of those things that an area needs to have, it's all of them, because it's when they work in concert with each other that we see an area that really will thrive in the period of time that you need it to thrive in. If you can get it right the first time, you can get it right the second time and continue to get it right over and over again, instead of buying the wrong thing straight up and having to learn your lesson from something that you haven't bought well. You need to do some research and get some education under your belt before you do a single thing. Robin from Victoria, welcome to the program, Robin.
Hi, Margaret. I'm just inquiring on your thoughts for Aberfeldy in Melbourne, which is Essendon.
Yes, it is indeed Essendon. And I think I've told this story before, but apparently I'm an Essendon supporter, having been recruited without my knowledge last time I was in Melbourne. You sneaky guys, you're so desperate to have people in your clubs. All of a sudden I had Essendon mints and a whole pile of stuff. Found I was an Essendon supporter.
Well, it's an area close to my heart because I actually live in this area. So from an investment point of view...
You're going to talk it up now.
No, I'm not going to talk it up. I'm going to give the basics of the area. We're seeing a lot of infrastructure change in regards to Mount Road and also coming in Buckley Street. We'll see a bit of changes there. And then we're also going to see Keilor Road take on a little bit more density. That's a great news story. It's not where we're going to invest, though, in terms of let those medium density properties come online. We're going to cherry pick the older properties in the back streets around that particular area, and that's something that I'm a big believer in, because what these new medium density properties do is they give the critical mass that supports the Thai restaurants and the living and lifestyle drivers associated with that. So for me, it's definitely on my watch list. And it's something that the only thing you just want to look at is it is by car. The foot traffic or the walk score to the local train station is a little too far. But sort of looking around that sort of Moonee Ponds, Essendon, Aberfeldy area, it's certainly one for growth and certainly long-term investing.
Brad, you're also from Melbourne. I wonder whether your thoughts concur with Ben or whether you think differently.
My duty of disclosure would be along the lines of that my maternal side, mum's side of the family are all from Moonee Ponds and Essendon. So I look at that area as one of those fantastic areas to live in, right? So depending on what sort of property you're looking at buying, because it is a great place to live, the question mark would be you'd have to be careful about what you invest. Yeah?
And I must admit, I tend to agree with that. I think it is a great place to live now. Of course, it wasn't years ago, and like all good areas, at one time they were probably the dodgy area that your parents told you weren't allowed to even walk through, you know, in the afternoon in case something happened to you. It has become one of those areas that's becoming more trendy, and certainly people are choosing it as a lifestyle. I think, you know, people love to live in those kinds of areas that now have that nice culture and age around them. Would I invest in an area like that? I probably wouldn't, because I prefer to go into those really undervalued area that nobody's discovered yet. I want to buy Essendon before it became trendy. And I think Aberfeldy is one of those areas where, okay, it's not Essendon, but it is Essendon. The name's probably been put there so that people don't think it's Essendon anymore. A little bit like Strawberry Hills in Redfern. And I think you wanted to buy there 20 years ago, so why don't you go and find another Essendon in the making, another area that nobody really likes, that will one day become that area. I'm talking Frankston as an example, an area that at the moment you people down in Melbourne are very uncharitable about, but is a great area to buy in because there's so much going for it, and there's a huge lifestyle opportunity there that as and when the Mornington Peninsula begins to open up and grow, you're going to see Frankston being the gateway to that area. You'll probably get some fabulous growth there. You want the biggest amount of growth that you can get in the shortest possible period of time in all investments that you undertake. Thanks for being with us. Time for a break now, but when we return you'll have another chance to ask your question and possibly win the book of the week simply by calling us on 1300 30 34 35 or emailing us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and joining me tonight on the show is Ben Kingsley from Empower Wealth and Brad Matthews from Rescom. We've been answering your calls tonight, and if you have a question and would like to be in the running to get a copy of my brand new book, How to Achieve Property Success, call us now on 1300 30 34 35 or email us on property@skynews.com.au. And Michael wrote this week with a question about property management, and he asks, "Hi Margaret, I've recently had my experience experienced property manager move on to a new job elsewhere. I was happy with her service, but I've now been assigned a new manager that has no previous management experience. He's an older gentleman who seems to be knowledgeable about his roles and is backed up by 4 other property managers in the same office. Should I give him a chance at managing my property, or should I ask for another experienced manager within that office? What would you do, Brad?
Michael, there's a couple of pros and cons on that one. I'm not sure what state you're from, but in the state of Victoria, for them to be a property manager, they actually have to be licensed to manage your property. So that's the first part. So maybe his knowledge on the outside may not look like he knows it all, but he has a basic standing that he should have. The second part of it is, why would you want to be the guinea pig? That's how I would look at it.
Okay, so what is your advice then?
I would ask the owner of the real estate business that if I'm still paying the same commission to them for an inexperienced manager, why should I be doing that?
Okay, that's a good angle. Is that your angle, Ben?
I'm more of property managers need to be great people. You know, they need to read people well. They need to understand, because obviously anyone who's putting an application up is on their best behaviour. So a mature age individual who's looking after that, if they've had worldly experience and they can read people well, I reckon I might give them a chance, because they're going to be eager to be able to do that for them.
Okay, well, look, I think what I would do, Michael, is I would give him 6 weeks. I think in 6 weeks he can deal with most things and prove to you that he's good at what he does. At the end of 6 weeks, then I would make the change. If you don't want to jump out of what could otherwise be a great property manager, if he is backed up by the other 4, remember that last property manager was backed up by the same 4 people. And so it could be a great place to work. I guess it depends on how long they've worked there. If they seem to be turning over really quickly, maybe it's not a great place to work. Give him 6 weeks, see how he goes, and then maybe exercise your rights under the termination clause and change over if you need to at that stage. Amanda, you're joining us from Kingswood. How are you going?
Good, thank you.
You're a bit worried about Harry.
Yes, I've seen him on the news lately, and we were just looking at buying a unit up in Hope Island, and I'm thinking, oh, do we hold off or do we go ahead and buy the unit we're looking at?
Is the unit as an investment?
It is as an investment. It's our second investment, and it is to be purchased off the plan as well. So yeah, and I've just seen this, and I've seen a few other little things in the news lately, and I think, oh, is it wise to go ahead and do it, or do we hold off a little bit?
Well, I want to tell you before I go to the panel that Harry Dent isn't the thing you need to worry about.
Okay.
What you need to worry about is investing in an off-the-plan apartment on Hope Island. And if you think this is going to be a good investment, then I'm pretty sure that the panel is going to have other thoughts. Let's see what they have to say. Brad.
First one, Amanda. My wife lives in Malaysia, and she sent me an email about 3 weeks ago saying, darling, I've just got this email about a man called Harry Dent, and the entire Australian market's about to collapse. Should we be worried? So what I did, I asked her to Google Harry Dent and to go back several years over all the time that Harry's been saying the same thing and the same thing and the same thing, and one year he may get it right. But what you actually have to look at is, what is Harry Dent actually selling? All right, so Harry Dent is a share market advisor who likes to talk up the share market. All right, so that's what I'd be looking at. Separate from what Margaret has said about buying at Hope Island and things like that, actually do some research and have a look at Harry Dent first.
Absolutely. Ben, I get nervous about anyone investing in anything with Island in the name.
Access to tenancy and access to work areas, Amanda. Hope Island, it's hard to get to and from. It's completely speculative in my view, and not only just off the plan, but the fact that it's got this remoteness attached to it. Now, the Hope Island conversation in terms of affordability, they're marketing on that they're sort of saying that this area is set to go because all of the mainland areas are doing well. I don't buy into that, so my research would be revisit the numbers, go and have a look in terms of what you're about to spend, and have a look at alternative areas which have got proven performance indicators and have given long-term growth and are going to continue to give you that.
Amanda, I frequently talk about the triple whammy when you're investing in property, and that is that the area needs to have infrastructure, it needs to have education and access to plenty of it at all levels, and it needs to have diversified employment opportunities. When you're talking about island investing, there normally, and what you're talking about at the moment, which is investing in an off-the-plan apartment on an island, that's a double whammy, as in a double bad whammy, I think. Off the plan is tricky enough, but going for off the plan and also doing it on an island where there's limited opportunity for growth, there's very little employment on islands, there's often difficulty getting a lot of your basic needs, and very often you've got to go to the mainland to get that. And even the islands where they're building some infrastructure, it's still not the place to buy. I'd venture to say that you're being sold this by a spruiker who's done a pretty darn good job on you, and I think you need to become more educated before you make this next step. I hope your first investment property is a good one, and if it is, you need to be careful here, because this second one is shaping up to be a dud if you proceed with it. Thanks for tuning in. It's time for our last break, but when we return, we'll of course take some more calls and read a few more emails. To have yours answered, simply call now on 1300 30 34 35 or email us on property@skynews.com.au. Welcome back to Your Money, Your Call. I'm Margaret Lomas, and it's been a great night with my expert panel, Ben Kingsley from Empower Wealth and Brad Matthews from Rescom. We've been busily answering all of your calls, and they've been great tonight. But if you've got a question, call us now on 1300 30 34 35 or email us on property@skynews.com.au. And Lee, you're waiting online, and you're talking about Toowoomba and WA.
Yes, I've been thinking I need to diversify my portfolio, and I've just got an interest in Toowoomba. I know there's a bypass that's going to be built now, it's been approved, and an area in Bunbury, Western Australia called Eaton.
Ah, Eaton, yes. No,
Yeah.
Eaton. Okay.
So I'm not too sure. I just procrastinate, and
yes,
it's hard to sort of make a decision. I'd just like to hear what your views and the panel's views would be on those two areas.
Okay. Do you have a view on this?
No,
you probably don't have a view on either of those, do you? Because they're not really your area, are they? Ben, let's chinwag a bit about Toowoomba, which I love. I love Toowoomba. And, you know, we've been talking about Toowoomba for years now. It's got a lot going for it. It has a mining influence without relying on mining, so it's there at the bottom of the Surat Basin. It's also got some fabulous roads back into Brisbane now, but in and of itself, it's quite an economically vibrant little hub. 9 councils about 7 or 8 years ago merged to make one super council with a fabulous mayor in place there. You know, Toowoomba's certainly worth looking at.
Definitely is, Margaret. And Lee, I'd be saying the same thing. In terms of what we like about Toowoomba is that affordability story. Now, the whole Brisbane and the Brisbane wave is going to hit out into the Toowoomba region. Sentiment for Brisbane, I mean, you need to talk to any commentator at the moment and everyone's on the Brisbane bandwagon. Sydney's having its run, Melbourne's had an incredible run for the last 5 years, so when you're generally making commentary around a particular marketplace, everyone's sort of saying, well, logically Brisbane's next to go. Now, there are a couple of interesting things about the Brisbane marketplace. Just the general economy needs to show a bit more sign, but then when you go into the Toowoomba and you look at that Surat Basin and you look at the gateway into those markets, and then you're also seeing the bypass, as you mentioned as well, it's definitely a good story. My only concern with Toowoomba is, with all of the development slowing down in the Gladstone areas and so forth, is it going to give an influx of developers who are going to chase this? So if you're going to get in the Toowoomba market, the time is now. And the time is over the next 3 to 6 months to get into that marketplace to get that baseline rise, as opposed to getting in 12 months, 18 months later, because it will overshoot. All of these growth areas do overshoot a bit and they'll find their baseline. And it's definitely going to be a better baseline than what we're seeing today. So for me, Toowoomba's a go.
Yes, and we've certainly been talking about Toowoomba for a very long time now, and we've seen movement already in that market, and I wouldn't leave it any longer, because otherwise it's going to be just like the western suburbs of Sydney. I can remember doing a town spotlight out in Seven Hills and Blacktown around about 4 years ago on property success, which of course airs here on Sky News Business on Saturdays. And when we did that town spotlight, a lot of people questioned the wisdom of suggesting that the western suburbs were ever going to do anything. And of course here we are now right in the middle of a major boom out there, and it's too late to get in, and anyone who did get in 4 years ago after they watched property success is sitting on a pretty little profit from that now. Toowoomba is going to also grow, but it's almost too late for you to really make a lot of money from that. In terms of Eton in Bunbury, one of the things about Bunbury is, although it's a similar distance from Perth that Toowoomba is from Brisbane, being around about a 2-hour and 20-minute drive now with the new road through to Bunbury, in between Bunbury and Perth, there's very little until you hit Mandurah, and Mandurah is only about 40 minutes south. Now, with Toowoomba, in between Toowoomba and Brisbane, you have Ipswich, Redbank Plains and all of the Logan Shire, plus not to mention the Lockyer Valley and Gatton and everything else in between. That's the big difference, and that is why Bunbury is still a long way from becoming much. They still have to build much more south of Perth for Bunbury to actually perform well. It's had a bit of investor sentiment recently, but it's not going to do a Toowoomba for some time yet. Toowoomba's definitely your market for now. Well, that's it from us. Thanks so much for being here and for the great questions. We'll be back again next week. And joining me will be Damien Collins from Momentum Wealth and Brad Beer from BMT. So be sure to tune in then. My guests this week are Ben Kingsley from Empower Wealth and Brad Matthews from Rescom. Did a fabulous job, and I know that they're going to be keen to be here to answer your questions again later on in the year. Thanks also to our callers and emailers, and your questions tonight have been fabulous, but the panel and I have agreed that we want Amanda not to invest in Hope Island, and so Amanda, the book is going to be coming your way. All you've got to do is email me on yourmoneyyourcall@destiny.com.au. That should come up on the screen in a moment. Your money, your call, there it is at destiny.com.au, and I'll send you the book if you can send me your address. If you missed out, you can get the new book from my online store at destiny.com.au. This is a great book for every budding and experienced property investor. You can also get it from all good bookstores, and a couple of the bad ones I'm sure stock it as well. If you're sitting there in Melbourne wishing that you knew how to get started, this week is your last chance to register to attend my Essential Property Education course. It's on in West Melbourne this weekend coming. Check out my website, destiny.com.au, for more details. That's it from us. Thanks for being with us. I'll see you again next week.
The information featured in this program is general in nature and therefore should not be relied upon. Guests appearing on the program may have commercial arrangements with some of the companies mentioned. Before making any investment, insurance or financial planning decisions, you should consult a licensed professional who can advise whether your decision is appropriate for you.